We on? Well, it's 4 o'clock. Welcome everybody to Krasney Financial's review of the first quarter of 2011 and a look at the remainder of 2011. Normally, I generally start these presentations with a touch on where we've come from, and Steve sort of takes over with where we're headed. But I thought, in view of the subject matter for this week, or I should say for this quarter, there were a couple of articles that I noticed myself. One was this morning in an industry journal called Investment News. And I don't know if you can see this, but I clipped this. It says, as clients dial up risk, advisors feel the heat. And what has happened over the past year or so is we have gone through a very potent forward-moving stock market, which has gone up in value about 100%. And now, with advisors dealing with clients who are still on the side, and also with clients who have been conservatively invested, people are now beginning to wonder whether this market is going to continue and whether or not they ought to raise the heat under their portfolio. So I clipped this article. I highlighted several sections of it that I want to run through very quickly because I think that they are so on point for the way investors typically think going into markets that are rising dramatically or sinking dramatically. So I'm just going to sort of breeze through this. This had to do with an advisor by the name of Rich Zito, who is not anybody that I know, but the article starts out, some of his most conservative clients call and ask if they should invest more aggressively. Those calls are the canary in the coal mine, according to Zito. They usually mean the markets have gone up too fast and that the market run might soon be over. The S&P 500 almost doubled from its low in March of 2009, Mr. Zito notes. He is one of a number of financial advisors who are fielding calls from conservative investors asking if they should take on more risk in the hopes of greater returns. Bullish investor sentiment has been on the rise in recent weeks, reaching 42.2% on April 14th, slightly ahead of a 39% average. Bottom line is, he says, we're up almost 100% from the bottom where many investors wanted to sell. Now we're up 100% and you want to buy. Advisors are finding themselves in lengthy conversations reminding clients of the horrors of the market meltdown of 2008. I have clients who are up 3% and asking why aren't they up 6%, says Bob Weiss, a director of research at another advisory firm. These are the same folks who didn't want to lose 6% a year ago. If the S&P goes up 15% and then drops, how much of that are you willing to lose? Part of the problem has been compounded by the bond market's travails, which I'm going to touch on in a moment. There's been talk of a bond bubble, and investors want to know whether they should buy more equities. Quote unquote, when the cab driver knows what to buy now, it gets pretty scary. Federal Reserve rounds of quantitative easing and the fact that the government is printing money to get the economy to recover, and it hasn't made a dent. What will happen when QE2 ends? Many advisors want investors to remain in a conservative stance. Investor sentiment numbers and mutual fund flows indicate that there is still some room for asset bases to grow, according to observers. The American Association of Individual Investors Sentiment Index is still down from the beginning of the year when it hit 55.9%. Last month, U.S. equity funds had $934 million of outflows, while taxable bond funds had $18 billion of inflows. I see signs of it as well, but I am not. This is a gentleman by the name of Bob Dahl, who is an executive at BlackRock. He says he sees signs as well, and that is of the topping quality starting to show in the market. However, the fundamentals continue to support economic growth, he says. It's only when the last guy comes in that you should be worried, Mr. Dahl said. And so my point in skimming through this to you all is that we have had a robust run, and in my opinion, what we ought to remain firmly focused on is the fact that we want to be on course to achieve our objectives. And through strong markets and weak markets, it's where we are relative to achieving our objectives. The other issue that I wanted to touch on, which is very near and dear to me, I saw an article in the New York Times, April 10th, beaten down munis may offer some bargains. There has been a lot of headline attention called to the underfunded pension and tight budgets of many of the states and municipalities around our country. And people have actually said to me, gee, I don't want to buy muni bonds right now. And when I start hearing that, it has made me believe that we are over the top in terms of reverse sentiment. Muni bonds as an asset class really are second in quality only to United States Treasury paper, which is an absolute guarantee by the federal government. Bonds themselves are absolute obligations of their issuers. And to the extent that issuers have the ability to either raise fees or levy ad valorem property taxes, there really ought not be any issues with the payment of principal and interest in the muni market. Investors that are buying munis from this firm, I don't actually mean buying them from the firm, but who are investing in portfolios that carry munis, in our opinion, are well protected, safe, sound, and secure. We feel that the big risk in bonds, munis, agencies, corporates, and governments is really the interest rate risk, the inflation risk, the risk that has a tendency to push interest rates up. And what we feel as a firm is that if we can mitigate that interest rate risks and our bonds just continue to pay as they have all the way through the Great Depression, we ought to have an expected result similar to that which we've had in years past. All the way from 1929 to present, investment-grade bonds have a payment record that exceeds 99%, timely payment of principal and interest. I personally do not expect that payment history to change noticeably. I think that Meredith Whitney's call of hundreds of billions of dollars of defaulting bonds was an overstatement. I know many colleagues in the bond market agree with me, and I just wanted to take a moment to say that I think we have a situation presently that is very unique in terms of creating attractiveness in the muni bond market when you have tax-exempt securities in many instances yielding almost double what taxable treasuries are yielding. In normal times, treasuries generally, or let me work backwards, munis generally yield about 70% of the return of taxable bonds. And so in an instance where you have 5-year munis yielding in certain cases 4.25%, you have 10-year bonds yielding 5 1/8. AA-rated Allegheny County, Pennsylvania, came at 5 1/8, and the 10-year Treasury rate is 3.5. 5 1/8 tax-free to a Pennsylvania investor, both state and federal, versus 3.5 federally taxable. Let me think about which one of these has a better net rate of return to me. It doesn't take too much thinking. 4.25 on 5-year paper, A-rated, is available in the marketplace versus 2.25 on treasuries. Bonds are a unique investment opportunity, in my view, at this point, and we're going to continue to seed the portfolios with short-term investment-grade bonds that we think will carry the portfolios to stable results in a very predictable way. With that being said, let me just touch on the agenda of our meeting for today. What we're going to do is have a review of the first quarter, talk about where we came from, take a look at where we see things as we look forward the next 1 or 2 quarters, and perhaps further than that. Look at what our portfolios are doing, positioned as they are, and then tell you about some very interesting things coming soon from our firm. So let's talk about the key takeaways from today's review. We expect to see reasonably mediocre returns with above average risk over the next 3 to 5 years. We expect bond results could be low due to the current yields being offered by bonds and the potential of rising rates, although be advised that that potential of rising rates is most dangerous and the risk is most exacerbated on the medium to long-term bond market, which we are nowhere near at this point. We see opportunity in other asset classes and strategies that, in our opinion, collectively offer competitive returns with what we view as less risk. And if stocks continue to climb, we could begin to trail our benchmarks. That remains to be seen, although when you see Apple, I guess, blow the doors off its expected earnings with a 95% increase, it makes one wonder just how far and how fast this market can continue to go. At some point, we believe the core problem of excessive debt, both consumer and federal, can only be resolved through the painful steps that will reduce economic growth, and those are in large part deleveraging. Let's talk a moment about a review of the first quarter of 2011. And again, let's talk about U.S. stocks continue to march closer to peak 2007 levels. We all know that. Everybody saw the S&P up about 6% in the first quarter of 2011. Foreign stocks were up by somewhat smaller amounts. High-quality bonds were roughly flat for the first 3 months of the year, and emerging markets bonds and high yield both had a good quarter. Steve, you want to take it from here with our performance outlook, our investment outlook?
Sure. Thank you, John. Just in terms of the economy, there's a lot of conflicting forces impacting the economy right now. And the economy is improving. There are some steady improvements that are occurring on the economy. But there's still a lot of negative forces that we don't see going away anytime soon. Household debt is still very high. The labor market is still very weak. The housing market, although it's recovered somewhat, is still struggling. And government deficits for the U.S. and across the globe are also in pretty bad shape right now. On the other side of the ledger, some positive things are occurring. A lot of it is revolving around emerging markets and the growth that emerging markets present to the global economy right now. The bottom line on the economy is we don't think that a return to a more normal environment is likely over the next 3 to 5 years. Slow growth is really where we expect things to continue to be. This chart just gives a very brief summary of why it's important to track the economy. I mean, we're not directly invested in the economy, but it's important to note that the economy is closely correlated with earnings growth of corporations. And earnings growth of corporations, in turn, drives the rise of stocks. So if the economy is going up or down, it's going to have an impact ultimately on the equity markets. So over the next 3 to 5 years, which is generally the preferred period of time where our analysis works best, stocks are selling above a fair value range right now. There's risks out there to the downside. Foreign stocks are trading at similar valuation levels, so again, not terribly exciting returns are expected for broad market indexes. Emerging market stocks are likely to continue to perform fairly well, but they're much more volatile, so the risks to the downside are much more heightened as well. On the bond side, John touched on this just a bit. In terms of the bond market indexes, which are heavily weighted towards treasuries and longer-term bonds, rates are currently low. The possibility of rates rising will have a negative effect on long-term bonds, and therefore returns for bond market indexes as an asset class are also not terribly compelling at this moment. Here's another nice chart that we pulled out, and this reflects price-to-earnings ratios. And essentially, without getting complicated, PE ratios are a gauge of how expensive or cheap stocks are. And if you look at this chart, the flat line going right down the middle, that's the average PE ratio of the stock market. And the graph, the line chart shows where we are right now. We're certainly nowhere near where it was during the tech bubble or the real estate bubble that we had just a few years ago in 2008. But we're still fairly high on a relative basis, and that's in part why we believe stocks in general are trading above fair value range. So they're not cheap at this level right now. On here also is a nice chart that shows the long decline in interest rates going back from 1980 to present, and that decline in interest rates served as a nice backdrop for bonds, and is why bonds have been such a good asset class over the last period of time. But how low can interest rates go? We don't think they're going to continue on this trend downward. In fact, we think that the next move is likely to be up. I won't go into this slide in too much of detail. John covered muni bonds in detail. One thing I will add to John's comment is the negative headlines that are out there, we don't really think they're going to go away anytime soon. There will be some issues in the muni bond market. We don't think it will have significant impact on the muni bond market as a whole. But if the negative publicity starts driving people to sell muni bonds, it could actually create a compelling opportunity to invest in muni bonds as an asset class. And maybe even beyond just the short-term bonds that John has been speaking of. We're not there yet, and we probably won't get there because I don't expect munis to sell off dramatically. But if it were to occur, that's an area that we're watching very closely, and we would certainly participate in if the valuations became even more attractive from where they are right now. So in terms of how we position our portfolios, I mean, we painted a pretty negative picture so far. And I don't want anyone to get the idea that we expect the market to sell off next week and never come back up. What we're trying to say is there's a wide range of outcomes that are possible out there right now. What we have been discussing so far is the most likely outcome over the next 3 to 5 years: slow growth and risk to the downside. But how we get to that over the next 3 to 5 years, there's a variety of different scenarios. We could go up another 10%, drop 20%. We could just continue to chug along 3% a quarter like we did this current quarter, or we could stay pretty close to current levels. So in terms of the analysis that we do, we like to focus on a variety of different scenarios and position our portfolios in a way that they should produce reasonably good returns in all the scenarios, ranging from the most positive or bullish to the most negative or bearish. And that's the whole point of why we stay diversified. That's the whole reason why we will make tactical shifts in our portfolio, but we won't do it to the extent that it could, if we are wrong, it could do damage to client portfolios. So any shifts that we're going to do for a conservative client are going to be a little bit more moderate to a more aggressive client who is expecting more growth. The bottom line of our strategy is we want our portfolios to do reasonably well over a longer period of time under most scenarios. And the way we do that is by avoiding mistakes, not sticking our neck out, and relying on valuation analysis, which has performed very well for us and for our clients. Another thing that factors into our portfolios is actually how we construct the portfolios and what makes up the allocation of our portfolios. And for that, we focus on 3 parts of the portfolio. We've been doing this for years, although we're making a more we're doing a better job of communicating with clients now, and you're going to see a lot more verbiage in our conference calls and also in our letters relating to the different parts of the portfolio and what role they play. The main part of every portfolio is what we call core. It's a pretty common term in the industry, but it might be unique to clients. The core part of the portfolio is designed for efficiency. It's designed to track the major indexes, and the way you track the major indexes is through vehicles that are tax efficient, low cost, and provide nice exposure either to stocks or bonds. The tactical side or components of the portfolio, that's where we're trying to add value. Those are the shifts that we've made over time in high yield bonds, emerging market debt, REITs, underweighting a small cap, overweighting a different area of the portfolio. Those are tactical shifts that we make, and those are designed to outperform the broad-based indexes, and they're opportunistic investments. You're not always going to have the same tactical investments. What's valued today could be very different 2 years from now, and so it needs to be flexible. The alternative side of the portfolio, that's designed to reduce risk, and the way we do that is by investing in asset classes that don't move up and down the same as traditional stocks and bonds do. And again, it's not an area that we've emphasized too much in the past, but it's an area that, especially given our I'll say boring outlook for stocks and bonds, alternative assets are an asset class that we think we can continue to generate nice returns for clients without exposing them to all the downside risk. And in terms of the tactical shifts, this chart is a very simple way of looking at how we manage tactical or opportunistic positions in the portfolio. So if you look at this chart, the dotted line represents valuations of an asset class, whatever the asset class is. And there's different metrics that go into evaluating different asset classes. So for the purposes of this chart, the value of an asset is going to go up or down over time based on supply and demand. The yellow chart or orange line represents the fair value of that asset class. So what we're looking for is opportunities where the orange is the fair value, the dotted line is the current prices. So we're looking for opportunities like is being highlighted right now, where we can buy an asset class far below the fair value of the asset class. That provides a margin of safety. That provides an opportunity to profit when the relationship gets back in line. And what we try to do is exploit those opportunities. The good thing about that is over a longer time frame, this valuation analysis is very effective. And clients who have been with us for quite some time have seen it. They've seen it impact their portfolios in a very positive way. The only downside to it is the timing of those moves is a little bit more unpredictable. We're not trying to get in and out of asset classes day to day, week to week, or even quarter to quarter. We're really looking for areas where we can, or valuations where we can start to invest portfolios, and we'll generally do it in a staggered fashion. And we hope over the next 3 years, 5 years, the valuation of that asset class is now trading at fair value. And when that occurs, we shift back to a more normal allocation. The way it impacts our current clients, is through some tactical positions which we've held for quite some time. Emerging markets, local currency bonds, we still own them throughout our client portfolios. Yields are very attractive, and they provide a nice hedge against the dollar decline. And recently, the dollar has been declining once again. High yield bonds. At one point, we had a fairly large position for client accounts. They've rallied so much that we've taken some money off the table there, but we still own them in a smaller fashion. And we still like them primarily because the yield is nice for our clients, particularly clients who want income, and also because it provides expected returns that should be similar to stocks without all the downside risks. There's a variety of flexible income funds that we use as a supplement to the individual bonds that John buys. And these types of funds tend to be a little bit more aggressive and tend to have a wider reach. So they will invest in issues that are overseas and in emerging markets. They will dabble in currencies, other sophisticated strategies that it's better to invest in through a fund. And you'll see those in your portfolios through a variety of different funds: Lumison Sales Bond, PIMCO Total Return, Metro West Total Return, PIMCO Unconstrained Bond. These are some of our favorite funds that are in a lot of our client portfolios. And the alternative strategies, this is something that's new. We've spent a lot of time and a lot of research into this area over the past year, really. And you're going to hear more from us on this, but we're particularly high on arbitrage strategies right now. Again, it's a fairly sophisticated strategy, but it's designed to take advantage of mispricing in the marketplace, and it's designed to generate slightly higher than bond-like returns, but without any interest rate exposure. Floating rate bank loans, again, is a nice asset class that we've spent some time researching. And it has some merit, and it's something that warrants more consideration to adding to client portfolios. And structured notes are also something that we expect to roll out for clients in the next few months, really. And a lot more information will get passed along to you on those. You can look out for that. But in summary, a structured note provides exposure to the equity markets with some downside protection. So one of the concerns that we have in the stock market is there's a lot of downside risk. So a structured note will allow us to participate in that stock market index and cover some of or create a buffer area where should the market drop 10 or 20 or maybe even 30%, clients wouldn't suffer losses. The cost of that buffer is to limit the upside a little bit, but in the current market right now, we can get some attractive terms, and again, we're going to provide a lot more information to clients on that in the coming months.
Thanks, Steve. I was noting, not to reiterate anything you said, but when you showed the graph of the current market valuation versus a normal valuation of an asset class, I noted that green icon, Travis, if you want to go back, right there, that green icon looks to me, just looking at it, to be about the point in the cycle where we began to nibble at high yield in November or October of 2008. We hadn't hit the bottom yet. We started nibbling. We started nibbling again in February, and then the market turned and we had that tremendous run-up. So that, I think, is a very good example of the way we look to find disparity between current valuation and fair market valuation and take advantage of it. So there you go. Travis, you have some things that are going to be coming up from us that you wanted to touch base on. Why don't you take it away?
Thanks, John. I wanted to talk about a couple things that our clients can expect from us, some changes going forward that you'll see around the time of the second quarter statements are released, so around June 30th of this year. Periodically throughout the years, we've done surveys and asked the clients what they think about the reports and other services we provide to them, and we've taken note, and also through quarterly calls and meetings with clients, we've heard comments and suggestions and recommendations that we can add or things we could change, and we've listened to our clients and we've changed a few things, and you're going to see those in the next few months. The first thing that you'll notice from TD Ameritrade in your May statements, they're going to be changed slightly. They're going to be reorganized. They're going to be consolidated. TD Ameritrade has poured millions of dollars into their reports that they're going to release in the next month, and they're going to give you a clearer view of your assets. They're going to remove a lot of information that is just extra information that people didn't want and cut right to the point. And they've done a lot of testing on these reports, and they really believe that they're going to get the point across better. With our reports, the biggest change you'll see there is you'll see some charts added. You'll be able to see clearly how much of large cap you have, how much in investment grade bonds you have, how much in small cap, how much in high yield bonds, whatever it is. And then also on the other side of the report, you'll see a second pie chart that will break down the strategic allocation. So Steve was talking about this core tactical alternative strategy, and how much of the portfolio is core, how much of your portfolio is allocated with tactical shifts, and how much is alternative that is meant to reduce the overall risk in the portfolio. Then below, it will pretty much be our standard reports. We've consolidated some of the columns. We hope it's clearer for our clients. The second thing you'll notice is we're going to be relaunching our website at the end of this quarter. And the biggest thing from a client's perspective is now you'll have the ability to view your reports online, give your accountant the ability, if you choose so, to view your reports online. And the ultimate goal is that you'll be able to have easy access to reports. They'll be archived securely and safely, and you'll get them quicker. So, and we had a lot of people, they'll call us from their accountant's office and they forget to bring the report, or their accountant wants to access the report. Now you can access it immediately on demand in a secure way, and you can pull those reports at a moment's notice and print them or email them however you like. And you'll get a notification on how to set up your username and password very shortly. And the last thing, like Steve mentioned, is alternative investments. We've done a lot of research on different alternative investments, and we're about ready to roll out in a small portion of our client portfolios some alternative investments that the ultimate goal is to provide a different source of return that's not directly correlated with the stock or the bond market. So those are some things we're ready to bring to you. We're really excited about it. If you have any questions about it, give me a call, give anyone else a call. You'll be receiving a letter around the middle of May that will describe the things I'm talking about right here on this slide. So with that, we want to thank you for your time. If you have any questions, you can hit the Q&A button on top of the website. Looks like we already have one. And I'm going to open up the conference call, the phone conference call up for questions as well.
All callers are unmuted.
Anybody have a question? Okay. Any last moment thoughts that you want to add to what we've said thus far?
I think so.
Okay. Then without any further ado, let me thank you all for attending. You will be able to see this presentation up on our website in about how many days?
2 days.
2 days. So anybody who has not seen it in its entirety or gets questioned by a family member or a friend, if it's possible to see this quarter-end presentation, they will be able to see it on our website at krasneyfinancial.com at their convenience. One question has come in from one of our clients. The question says, what effect will raising debt level have? You want to take that, Steve?
All callers are muted and they can unmute themselves.
The debt of the U.S. government, I assume, is what the question has to do with. And that, I mean, rising debt is an inflationary force on interest rates. And that's in part why we think the risk of rising interest rates is high. The reason that relationship is there is because if someone has a lot of debt, for them to borrow more money, the person loaning the money is going to require a higher interest payment. So that was thus the rise in interest rates.
Anybody else? Okay, then let me thank you all for attending. We will be back presenting the second quarter's review the third Thursday after the turn of the quarter. Thank you all for attending, and we look forward to your phone calls and your continued presence on our site. Good night.